both confident and committed.
Okay, welcome.
And determined to.
What you in the background is the chairman of the Federal Reserve speaking during the FOMC press conference. It's 8:56 local time, 16th of September 2020.
1 month of
this euro dollar on our chart, trading 1.17964. You can see in front of your eyes live how the smart money pushes the price down against the dumb money longies, the dumb money buyers who try to buy a reversal. So this will be a failed reversal. The smart money will push the price further down and take out those stops here, down to 1.17864 and probably further below that. So that's why I'm short. There we go. Boom. You see, stops get taken out, they turn yellow and will disappear once they were eaten.
And not for a sustained period. You know, we're
boom.
Resisting,
there we go.
The urge to try to create some sort of a rule or a formula here, and I think the public will understand pretty well what we want. It's actually pretty straightforward. We want to achieve inflation that averages 2% over time. And if we do that, inflation expectations will be right at 2%, and that'll help us achieve 2% inflation over time and avoid the situation where the central bank loses its ability to support the economy.
Thank you. James Politi.
Thanks for taking the question. James Politi with the Financial Times. Do you consider today's enhanced forward guidance to have the actual accommodation to the U.S. economy from a monetary perspective, and sort of delivered further support for the economy, or is it just a tweak to your existing policy stance? And in terms of fiscal support, do you assume in your own projections, not just the private forecasters, that additional fiscal support will be forthcoming?
You can see all the dumb money long positions here. They're all into loss, all into drawdown. Those ones on the y-axis. These are all the guys that tried to buy euro dollar.
So in terms of the effects, so I think what we've done
pin exactly to the target.
Is more or less aligned with the consensus statement today. So it's in line with what might have been expected. As I mentioned, I think over time it will provide very powerful support for this economy as we move forward. In a sense, it's consistent with expectations. So I'm not looking for a big reaction right now, but I think over time. Again, guidance that we expect to retain the current stance until the economy has moved very far toward our goals is a strong and powerful thing. And I think that will be supportive of the economy over time. In terms of additional fiscal support, I guess your question is what would happen if, people have different assessments, and different participants in the FOMC made different assessments on their own. I think broadly, though, there is an expectation among private forecasters and among FOMC participants that there will be some further fiscal action, and there does seem to be an appetite on the part of all the relevant players to doing something. The question is how much and when. And so I would just say that if, and it's very hard to say, that so far the economy has proven resilient to the lapsing of the CARES Act unemployment, enhanced unemployment benefits, but there's certainly a risk, though, that those who are unemployed appear to have saved some of those benefits, and they'll now spend them, and that as the months pass, if there's no follow-up on that, if there isn't additional support, and there isn't a job for some of those people who are from industries where it's going to be very hard to find new work, then that will start to show up in economic activity. It'll also show up in things like evictions and foreclosures and things that will scar and damage the economy. So that's a downside risk. So I think the real question is when and how much and what will be the contents. No one has any certainty around that. But broadly speaking, if we don't get that, then there would certainly be downside risks certainly through the.
See how the smart money prices in those dumb money shorties here?
Thank you, Anakin.
You see?
Thanks for taking
the old
question.
ones. So they move up against them, so they are not able to quickly cash in.
And repeated calls for this in the Fed listens events. Is the Fed open to other measures of the economy, such as income inequality and affordability of housing?
So we monitor
Now it reaches
everything we
the
think is
upper long E
important
positions.
in the U.S. economy.
Which represents
and in
true
in a broad sense, all of it
resistance.
goes into thinking about monetary policy. You mentioned inequality. So, disparities in income and in financial well-being by various demographic and racial categories, something we monitor carefully. Inequality, which I would point to, it's a multifaceted thing, but I would point to the relative
There we go.
stagnation of income
Pull back
for
down
people at the
because
lower
the
end of the
money
income
long
spectrum,
positions here.
and also lower
They don't
mobility.
want to let these guys
So
get into
those are
profit.
things that hold
At
back
least they
our
need to do a
economy.
pullback.
They are.
So that's the reason why they
The
move
thing
the
is,
price
we don't
between
really
those
have the
two
tools to address those. We have
accumulations.
interest rates
The upper longies and the
bank
lower shorties.
supervision and financial stability policy.
And then
things
depending
like
on which
that.
kind of comment is
We
coming,
can't- we
what the
can't
dumb money
get
does
at,
next,
those
they
things
will
through our tools. When we lower the federal funds
respond
rate,
accordingly.
that supports the economy across a broad range of people and activities, but we don't have the ability to target particular groups. Notwithstanding that, we do talk about it because these are important features of our economy, and I think those distributional issues are issues that are really for our elected officials. And I would say I take them seriously as holding back our economy. The productive capacity of the economy is limited when not everyone has the opportunity, has the educational background, and the health care and all the things that you need to be an active participant in our workforce. So I think we can, if we want to have the highest potential output and the best output for our economy, we need that prosperity to be very broadly spread in the longer run. And I would just say the Fed, we can talk about those things a lot, and when we think about maximum employment in particular, we do look at individual groups. So the high unemployment in a particular racial group like African Americans, when we would look at that as we think about whether we're really at maximum employment. We would look at that along with a lot of other data. So the answer is we do look at all those things and do what we can with our tools, but ultimately these are issues for elected representatives.
Thank you. Edward Lawrence?
Yeah, thank you, Chairman Powell, for the question. I just wanted some clarity here. At what point do you think it's prudent to shift the bond purchases from market stability, as you had said, from the shorter-term maturities to more longer-term, more stimulus-related?
So, we think that our asset purchases are doing both those things today. We think clearly there's been great progress in terms of market function. If you remember, early in the spring when the acute phase of the pandemic hit, market function was very low, and it's improved rapidly and in many respects is in a good place now. We also, though, think that these asset purchases, which total $120 billion a month, which is much larger than for example, the last asset purchase program during the global financial crisis and the recovery therefrom, we think that that's also providing accommodative financial conditions and supporting growth, and we think that's fine. We're also aware that there are ways we can adjust that, to do various things, make it smaller, make it larger, and also target different sectors of the curve. And we're going to continue to monitor developments, and we're prepared to adjust our plans as appropriate.
Thank you. Victoria? Victoria Guida.
Hi, thanks for taking my question. I wanted to ask about a couple of things. First of all, if we don't get a vaccine until well into next year, what does that mean for the economy? And then, somewhat related, I was wondering if you could provide any more detail about the stress scenarios that you all are going to release for the big banks, and whether that is going to be another full-blown stress test, whether we're going to publicly see those results, and what it might mean for bank payouts.
Great. So on the first one, what's happening is basically we're learning to live with, right now, we're learning to live with COVID, which still spreads. And we're learning to engage in economic activity. All of this recovery that we've seen is in a context where, where people are still at risk of catching it. And yet we're able to resume lots and lots of economic activities. And that involves, as I mentioned,